time is of essence. Anyway, welcome everybody. So far we have over 50 people on our inaugural Miami Accounting webinar series. Our first speaker is Shiva. Before I hand it over to him, just a couple ground rules. Keep your microphones on mute, otherwise it interferes with everybody else. And if you have a slow Wi-Fi, you can disable the video feature and you'll get much better reception. Other than that, we're going to give Shiva about 20 minutes to present, and then we will do Q&A. I will be monitoring the group chat, and then based on the questions, I will have people unmute themselves to ask Shiva a question and give him enough time to respond. And then we will conclude at 1 o'clock. But if you have other information, please share it with Shiva about his paper. The nice thing about this session is not only the fact that we can reach so many more people around the world. We have people tuning in from Australia and Hong Kong and Europe. But the speaker can actually share the seminar with their co-authors. And this is something we've never had before in our workshops, because we invite somebody and they present the paper. And so this is a good way to kind of learn more about the research process. I know all of us have been in various stages of social isolation and social distancing, but at least for 1 hour every Friday, we can all get together and intellectually engage. Just a reminder, we have a few upcoming events so far, and there'll be more announced on our website. So I will be presenting on the 10th, followed by Bill Mayu on the 17th, Christian Lloyds on the 24th, Brian White on May 1st, and Jennifer on May 8th. And we are hoping we continue doing this every Friday. So what I will do now is I'm going to let Shiva take over and present his paper. Go ahead, Shiva.
Thank you. It's an absolute honor to be the inaugural guinea pig. But seriously, we all owe DJ a huge thanks and a round of applause for not letting the virus defeat us. Seriously, DJ. Thank you. Okay. So having said that, I have 20 minutes. So let me. I'm still learning my way around Zoom. So let me share my screen. This is my paper. Is Anish there by any chance? Anish, my co-author?
Yeah, I'm here.
Hey, hi Anish, how are you? Hey. So 20 minutes. I'm just going to give you a little bit of a background, perhaps focus more on the research process, because the paper itself is, if you buy the question, reasonably straightforward. But okay. So what are we doing here? So the socially responsible walk the talk. So I've been interested in this ESG, CSR stuff for a while, partly because, I go to India 2 times a year, and maybe India was a bit ahead of the curve. So they had this fairly bizarre rule which mandates CSR spending. So there's a rule which says that you have to spend 2% of your profits if you're a company of a particular size and basically larger companies. You have to spend them on CSR. And if you dig deeper, as you can imagine, it's a bunch of bureaucrats writing the rule. So they have all these bizarre ideas that CSR in that world by definition should be something that's not aligned with the company's mission otherwise, meaning you can't spend it on, say, daycare or a creche or something like that. So it has to be like pure charity in that world. And I've worked with a couple of my Indian colleagues. We predictably show large stock price negative reactions to that. And then, we wrote that paper. JAR was kind enough to publish it. The Indian regulators saw it, and so I worked with them for a while. And the idea was simple. How do you know whether any of this is actually spent well? And what's fascinating about India, this is what I discovered, even if you're from that milieu, unless you know the institutional environment, it is so hard to know what's really going on. So after a lot of probing, digging, the cynical conclusion I've come to is that it's effectively a slush fund for politicians. So a lot of this money ends up going into these so-called family foundations. And unlike the US, although these family foundations, I believe, are tax exempt, they don't file tax returns. So we don't really know where the money went. So they would put out these, 30, 40 page glossies on how they saved, poor hungry children and, saved a bunch of widows and so on. No numbers, lots of self-congratulatory BS in my view. And I kept asking the ministry, how are you checking whether there's any impact, whether this has happened, has it really done any good? And, there was like some toing and froing, but bottom line, nothing happened. So maybe that experience has tainted my thinking. And so how does Anish come in? So there was some conference and I'd written some CSR paper, which frankly never went anywhere. And I was designated as the discussant. And after the mandatory hazing, which you meet out as a discussant to Anish, we got talking, and there's some interesting connection. Anish's father actually went to the University of Iowa, where I got a PhD. So we got talking. Anish has an interesting way to think about fundamentals for ESG, which we'll get to. So that's how the paper came to be. And I've been writing a bunch of op-eds, since I went to the dean's office. I realized that, we do so much good work. It all just vanishes into ether space. Nobody reads our journals, sadly, despite what we might think. So I've tried hard to write for the average audience as well, and it's hugely rewarding. I mean, you reach so many more people. Even if you get 700 views, maybe that's 700 more people reading what I write than what shows up in our journals. So you can see a bunch of stuff here that we've written. Anish and I were talking for a while about how to deal with this, the CSR stuff. Then the BRT came up. So the Business Roundtable, as most of you know, got a huge amount of publicity, and it's a fairly significant break in the mood and the sentiment of this whole movement. And we did something fairly simple. We looked at the bunch of firms that were signatories to this BRT, and I'll talk a little bit about what that means for people who are not aware. And checked whether does any data line up. For instance, are these guys really as virtuous as they claim to be? And somewhat similar to my Indian experience, at least Anish and I don't really find that they quote unquote walk the talk, which somebody has told me is not kosher in the English language. Whatever, they didn't walk the walk or talk the talk or something. But anyway, so that's basically the paper. So what are we doing? So we have two settings. We have the BRT, the Business Roundtable signatories, who claim to be socially responsible. First of all, what is that is kind of vague, as you can imagine. And then maybe one way to enforce this social responsibility or this corporate purpose is through the world of investing. And I talked to many of our alums on the street. They're so excited about this whole ESG stuff. And if you probe them deeper, why are you excited? Well, it's an easy way, I think, to make fees. So, these are so-called socially beneficial funds. But if you look at the fee structure, it's like 1,500 basis points relative to what could have been perhaps done with a computer program. No wonder they're excited, because the one thing that our alums get excited by is making money. Not surprising, that's fine. So that leads us to the second setting. These so-called ESG funds, are they really investing in something that looks like socially responsible? Does the profile look like that's socially responsible? It's also a big opportunity, I think, for accountants, because this is completely a measurement problem, and it's been captured to some extent by either salespeople on Wall Street, a few believers in academia, and the economists. So if this is not a measurement problem, what is? It's a huge opportunity for us to jump on this, think about coursework, etc. And it's a very difficult measurement problem, which makes it all the more interesting for us as an opportunity. So that's how the paper came to be, and that's how Anish and I met. And then we're working on a few other follow-ups. It's been fun working with him. So why? I mean, I'm sure all of you have come across references in the media to pushing large firms to become socially responsible. There's been an explosion of ESG oriented funds over the last few years, mostly, I think, driven by Larry Fink's letter in BlackRock. And, let me share an interesting story there. Larry, so I think the number two person who reports to Larry Fink was on campus. And so somebody in the group asked the following question, how many people do you actually employ in your research group? And at that time, they said something like 24 people. So just imagine, these guys run what, 7 trillion AUM, assets under management, and there are 24 people doing the research, right? So there's no way. That whole business model is not oriented around finding information around anything, let alone ESG. So they rely on third-party intermediaries who have predictably sprung up to service demand, especially among state-owned pension funds and millennials who buy these ESG funds. So if there is demand for some score, there is supply. Right. And a lot of academic work also uses some of these commercial scores, which we'll talk about in a minute. And we're trying to look a little harder in the black box. What exactly are these scores? Do they line up in a sensible way, and so on? I've already talked about the two main settings. We looked at the largest ESG ETF, which is based on this thing called the KLD index, which a lot of academics working on the CSR, in CSR know about. That's been bought by MSCI, been rebranded as MSCI KLD. And then Vanguard has a fund. This is the largest mutual fund on ESG. They use the FTSE good US index or whatever. So those are the two things we're going to look at. So fairly straightforward. Here are people who claim that they have a deeper purpose beyond shareholder value maximization. We're just going to line this up with quote unquote fundamentals. It's like anything else you would do in valuation, etc. Right? But the hard part in this world is, what are fundamentals? They are not KLD and MSCI scores, as we'll talk about later. I don't think they do a good job. And this is where Anish has spent about 2 years working on cleaning up this database called Violation Tracker. And again, there's some history. So I had an army of RAs working in India trying to collect enforcement records of companies across various agencies like the OSHA and the EPA. It was a nightmare. I spent a lot of money. The paper didn't go anywhere. But remarkably, some genius programmer has figured out a way to collect the enforcement record across these enforcement agencies, and that's what Good Jobs First is. So, but it's again complicated. You can't just download and run this stuff. It requires a fair amount of cleaning, which thankfully Anish had done for his thesis coming out of Stanford. So this is our quote unquote fundamentals. And what do I mean by that? So why should you believe this versus say MSCI or KLD? Well, hopefully this is why. This is a list of 50 plus federal agencies that Good Jobs First collects data on. So they collect data on penalties, the citations issued to companies. It's a fairly comprehensive list of federal agencies. And, by and large, these are not coordinated agencies. When they do their own thing, their data structures are all messy. So the value added by Good Jobs First is to compile them for a company. So if you just go and say Amazon, for instance, on Good Jobs First, you're going to get a list of every citation that every federal agency in this list has issued in terms of penalties or problems and so on. A very long list, by the way. EPA, OSHA, Medicare issues, FTC, in the banking world, FDIC, Health and Human Services, etc., etc. The Foreign Corrupt Practices Act and so on. So that's our quote unquote fundamentals, and hopefully you'll agree that there's at least a little more here in terms of some economic basis for asserting that this might pick up something close to the E and the S record of a company. G, as you know, is complicated. There's lots of work on G. We still don't know what boards really do, or how to think about excess compensation very well. So we'll keep that aside for a minute. The paper mostly focuses on E and S and a little bit on G. So links to the academic literature. So one of the downsides of working on quote unquote, practical stuff is that it becomes hard to link it back to the literature. So we try very hard to try and address both these stakeholders, the academics and the practitioners. So there's lots of interesting work on corporate purpose, so here are a bunch of papers, both in the law literature, mostly coming out of Harvard, and but we don't know what that is. Whenever these people present, I've often asked them, can you tell me, does this actually work? What is purpose? Well, of course, but purpose is loosely defined as something beyond profit maximization. So the nice thing about our setting is that these are people who are self-proclaimed to have a bigger corporate purpose than simply shareholder value maximization. So we don't have to define purpose because that's a rat's nest, but these people claim that they have something beyond shareholder value. So let's go and check whether they actually do it, right? So that's one motivation. And the ratings, there are so many papers in academia these days on these ESG ratings. I'll cut to the chase, and what we find by and large is that these ratings pick up headline risk. So I've spent a lot of time with MSCI and their people just trying to understand the methodology. And I've never gotten straight answers. They'll say, oh, we use surveys. Okay, then what do you do with non-response bias? I've run some surveys as well. Oh, well, something, I don't know. Then they'll say we use like 4,000 units of data from all kinds of places. What does that mean? So by and large, what they're doing is looking at headlines. And let's say if there's a note which says Nike is using child labor in Bangladesh, Nike gets a black mark. At least that's how we've been able, that's what we think they're doing based on some of our empirical results. We still don't know what exactly they do, actually. I'm probably running out of time, 4 minutes here. So I'm just, so you saw what we're trying to do. I'm just going to show you a couple of tables, and I'm happy to leave the presentation online in case people want to look at it. So let me just show you the BRT results. So it's pretty straightforward stuff. We are going to find proxies for ENS from our violation tracker database, and we are going to regress that using a probit model on whether the firm is a signatory or not. What is remarkable here, and this is table 3 in the paper, hopefully the paper is online, is that the BRT guys are the ones who actually are worse in this respect. So they're more likely to have a violation. If you can see my mouse here, they're more likely to have penalties imposed on them, both on the environmental and the social setup. Social defined here as labor. How do you treat labor? Because social is another complicated thing, which we can probably have a conversation about. What is social? Now, there's one small caveat before you ask me about economic significance. The way the rules are structured in the US, the penalty numbers are capped to be reasonably small. So they are not ad valorem penalties, meaning you're not going to have a penalty as a proportion of the wrongdoing. So that's just capped by law. So, the dollar numbers per se don't have that much of a significance here. It's more the presence or the absence is the way to read this data. I'll talk a little bit about, they also seem to have worse G practices. Now, how do I measure G is again complicated. We do something simple. We looked at, amount of money they spend on lobbying, so-called abnormal pay, definitions in the paper in case you are keen on how we measure these things. This is the Bebchuk index. We don't find anything, but we actually find that they have fewer independent directors. I have a couple more minutes, so we'll quickly transition into the fund world. So what do we do in the fund world? In the fund world, by and large, we look at who are the members, and we look at these addition decisions, meaning when they add new members to these funds. And finally, we look at if they are part of the fund, does anything change in the future? That's our so-called influence test. And the short answer, to cut to the chase here, is we don't really find a whole lot in terms of correlating membership in these funds to our so-called fundamentals. If you look at additions of firms to the funds with our fundamentals, nothing in terms of influence, which means do the fundamentals change in the future? So that's the broad the broad summary of what we find. Again, all the details are in the paper. There's nothing. This is our key finding here, effectively, relative to violation tracker. Membership is not explained. So what is explained? This is my headline risk point. Using rep risk, if you find mentions of bad environmental news or anti-corruption news or human rights news, that lights up a lot. So this is the KLD effectively picks up headline risk is what we think it picks up, although we don't know for sure. And this lights up even after you control for the KLD score, interestingly. So this opens up a natural question, right? Is headline risk necessarily bad? So we ran some tests. It doesn't look like these things predict the so-called fundamentals, and we can talk about that in Q&A, and hopefully Anish can help us there as well. Same thing with addition tests. When you look at how they decide who to add to the so-called index, not able to correlate that with so-called fundamentals. This is our big takeaway here. Index creators in general appear to be reacting to news about ENS mostly, rather than actually screening for ENS issues. Probably not going to go to the conclusions. So DJ took 1 minute to kick things off, so I hopefully have 1 minute more. So bottom line, what should you conclude from this paper? There's very little evidence, at least as of now, that firms and funds that claim to have a higher purpose or whatever, virtuous or stakeholder oriented or ESG focused, actually walk the talk in terms of fundamentals. The charitable story could be maybe they'll get better in the future, who knows. But I think two caveats here in terms of what we learn from our work. One, we need to be somewhat careful about companies that make these social responsibility claims. It's almost easier to say things than to actually do them. A case in point, I've been looking at a couple of annual reports. Now, Home Depot's social responsibility report on their website actually has more pages than their 10K and their proxy. Same with Cisco. And if you look carefully, there are like hundreds of awards we got and how great we are, some glossy pictures. There's no real numerical content. I don't know what to do with all this stuff. So one has to be probably a bit skeptical of these claims. And second, there's a fair amount of work on CSR and ESG, especially in the strategy literature. And, finance and accounting is jumping on the bandwagon a bit now, partly because of all this interest and the money flowing into these funds. I would be quite skeptical of using these commercial ratings of ESG and CSR. I think all they basically pick up is headline risk, which is something you can do on your own using rep risk. And I'll leave it at that. Again, this is early work. We've never presented this ever. So thanks to DJ again for making all this possible. So I'll stop there, bring Anish on because he's going to take all the questions, and then look forward to some good conversations. Should I stop sharing, DJ?
No, you can keep sharing. Okay. The first person who has a question is Gennaro. So Gennaro, you want to unmute yourself and ask?
Hi.
Hey, how are you?
Can you hear me?
Yes.
Perfect. So the question that kind of I have in the back of my mind as you describe your approach is, the issue related to the endogeneity of the detection, right? And how the decision to be a signatory of the roundtable thingy might be related to your assessment of your own risk. You know what I mean?
Yeah. Okay.
Which is it's kind of related to the typical traditional problem in research of litigation-related research, right? The detection problem, which we only we only see ex post those that are detected. We don't see those that are not detected, and so.
So your worry is that they're concerned that they'll get hammered by the stakeholders. That's why they're preemptively signing up. Is that
correct?
Correct. Totally, absolutely possible. And there is some evidence of that here as well. I mean, they lobby regulators pretty hard. We could do more in terms of Actually, that's what we find. You're right. I mean, in the sense that you're more likely to be involved in lawsuits in terms of labor and so on. So that's totally possible. But the absolutely. And that hopefully helps us in saying that don't believe these guys, because if you look at the press, and you can say that the press is naive, maybe.
I'm not sure that I would agree with that interpretation, because, there is an expected cost from being caught as a non-socially responsible entity, but being the signatory of this roundtable thingy reduces that expected cost. And, presumably you might have all the intentions to follow, to improve your practices and so forth.
Okay. Yeah, go ahead. Sorry.
No, it's okay. Go ahead.
Okay. Yeah, you're right. So that's one of the things we say in the conclusions. I mean, you're right. We can't really rule that out. Hopefully you would give us that some of the funds are, there's some element of false advertising, at least in the funds. In this world, whether you're right or I'm right, I don't know. I mean, time will tell. We can look in the future to check whether their so-called practices really improved or not. But what you're saying is totally possible. Yes.
Okay. Thank you.
Sure.
Okay. Next question is Doug Hanna. Doug.
Had to find the unmute button there. The question is, I asked it, well, I share your pessimism in these ratings, so I'm not challenging the finding. If you're trying to prove essentially a null result, that these ratings are meaningless in many ways, when I read the environmental guidance, I see things like we're using less plastic, we're using more recycled materials in our production techniques, we're switching to solar and wind power as opposed to carbon sources of energy, reducing our carbon footprint. If you really want to prove a null result, don't you have to have some proxies that try to capture these kinds of inputs?
Okay, good point. So partly a philosophical rant and partly a more practical response to what you're saying. This is a multi-dimensional problem that can never be solved. So if you look at some of this, these reports, A, they're not comparable. B, there's no common unit like dollars to, essentially compile all this information in one place. People will say, I recycled X units of batteries or, PCs or whatever. You're right. The one, so it's almost impossible because there are so many dimensions. There is no way you can know whether one's better than the other in general. More than that, there may be no theoretically correct answer. Maybe in the environmental world, maybe there is a theoretically correct answer. I don't know. Maybe reducing emissions, and that's something that we could do as a follow-up. But in the world of S, what is the right mix for a company is an incredibly difficult problem to go after, right? So maybe gender diversity is high in my company, but I don't train people enough. Maybe that's the right thing for me to do. So defining what the right S is and what the right E is inherently difficult. Point one. Point two, your idea about, you're proving a null result. Well, to some extent, if you look at the world of funds, we do show you what they capture. We worked hard to do that, and it's somewhere here. What we think these things are basically picking up, as discussed, is headline risk. There's a press article which makes noise about something along these lines for a company. I think that's what this is picking up. So it's not totally null, and I personally don't have a very big problem with a null result, especially when there's so much hype around this idea that somehow these guys must be great people. If you open the black box, we don't find anything. Maybe somebody will.
Okay, I have a question, then I'm going to go back to the audience because I'm going to exert my privilege of manning the controls. Okay, So the question is, what is the right economic framework to think about this issue? So the one framework which most people use is somehow what firms do should have some consequence on economic performance. So result in higher cash flows because your customers care about it. You have your shareholders love it, so your expected returns are affected in a way. The second framework is this is just a way to manage risk so that you don't get regulated out of existence. So that's a second moment effect. And the third framework, which nobody really talks about, even though we use the word virtue signaling, there's an entire literature on signaling based on Spence, this is basically money burning. So the only firms that really care about this, who are in the BRT, are the rich, wealthy firms. They have a bunch of cash they're sitting on, and they don't mind burning it to show that they have cash to burn.
Okay. So excellent comments. Absolutely. So the first idea that when everything converges, there's no controversy, right? Unlike the India world, right? So for example, if you keep your employees happy, they're more productive. It's fantastic. That's S. Environment, that's a bit sketchy, but okay, let's say that you reduce emissions and so on. So let me think about this. So again, if you ask for a policy answer, I think the E part should potentially not be dealt with at the company level. So the unit of analysis here should perhaps be the some kind of municipality or state or a country, impose a carbon tax, make everybody pay it, end of story. Otherwise, if you devolve this at the company level and try to make it somewhat voluntary and so on, as we have done right now, it's going to result in the equilibrium we are in. A lot of window dressing effectively. So I've asked several CFOs, what confidentially, to the extent it can be confidential, I guess. Why do you do this? So they say a lot of it is millennials. Millennials care about this, and we have to be able to recruit them. I have to be seen as a quote unquote responsible company. So that was the world where labor markets were very tight, and they had to run after millennials to recruit them. My guess is that that's going to change thanks to what happened last month. So our MBA students are desperate to find jobs. So I'm presuming they'll be fine working for a tobacco company or an alcohol-based company. The third issue, I think, simultaneously, is the rise of passive investing. So virtually every company I've looked at in the S&P 500 is owned by 4 funds. BlackRock, State Street, Fidelity, Vanguard. The SEC forces these people to vote. In my view, they shouldn't even be allowed to vote. They just don't have the resources to actually go figure out what's going on. This is my BlackRock anecdote from before. So, but Larry Fink has people protesting outside his apartment in New York and in San Francisco, I guess. So what does he do? The easy thing to do is to write these letters to CFOs and CEOs saying you should be virtuous, you shall do this and you shall do that. Is there any economic basis for any of that? I'm sure a lot of us on campus have seen students complain about investing in carbon stocks and so on. Since stocks actually do very well, especially in recessions, perhaps that extra return can be used to fund research in going green, right? And remember, sadly, I think there's some irrationality floating around here. These millennials who buy these funds don't really know what's in there. They just feel good. The state pension funds, and I've talked to some of them, I'm just shocked by how naive some of these people are. The investment managers, they want to tell their firemen and so on that we do socially responsible stuff. If the firemen actually knew or looked at the returns of these funds, hopefully they'll discipline these investment officers. So I think there are several trends here. One is passive investing. Two, the tight labor market in terms of the workforce. What is the right economic way to view this? I mean, I guess we're both somewhat similar in this idea that, impose a carbon tax, let the politicians deal with it. The S part is easy. If it makes sense for your workers, you're going to spend money on S and we are done. I don't. It's a confluence, I think, of all these factors that has led us to where we are today. Now, in terms of a policy solution on how to solve the dimensionality problem that Doug was talking about, Hannah. So, I've written a couple of op-eds saying the idea is very simple. Just, identify one or two big evils that you want to get rid of, because we cannot go after like 90,000 data points where you say, I'm saving batteries and this and that. Write down a simple DCF model to tell us this is a CapEx decision. What is it going to cost to get to go green? So there are several power companies, I was talking to one of those guys. How have they gone green? They've got massive federal subsidies, right? Would shareholders have spent that money? Maybe not. This is what I have in mind. Write down a simple, DCF model saying this is what it costs to go green. There's usually never a conversation about trade-offs. Let shareholders vote on it and move on. Or if it's going to get resolved at the state level through a carbon tax, we are fine. I don't know whether that helps, DJ, but
yeah. I mean, for each one of these, let's go back to CFO saying the millennials value it. If they do value it, are they willing to settle for a lower wage? And then it should show up in labor costs. So if
Yep.
people are really making the first economic framework as motivating it, that somehow this affects performance, then it should show up in performance. If they're making the second claim that this is to reduce risk, that means I should get better terms on my bond. And if it's the third thing, then we know this is socially destructive, which is everybody's burning money because everybody else is burning money.
Okay, so a couple of points. One, maybe I'm a cynic, but I have never seen persuasive evidence for 1 and 2, the points you made, that somehow it affects performance better, somehow it reduces yield on bonds and so on. The third point about burning money, it also might be a function of the peculiar, capital market situation in the last 15 odd years, right? I may be wrong, but I think we don't have money for more basic things, let alone pursue ESG after this crisis. So there's some correction, perhaps. So maybe it's a particular response to a particular point in time when labor markets were very tight, especially the millennial idea. Yeah.
Okay, let me go to Daniele. Daniele, you want to unmute and ask your question?
Yeah, I think my question comes a little late. I mean, it's sort of related to what Gennaro asked before, which is about this selection issue. Although I was a little bit more concerned on the left-hand side selection, because the outcome that you are detecting here is not, it's based on firms' behavior, but it's also based on the agency behavior of detecting a wrongdoing of the firm. And so I was wondering if you are concerned that the firms that are, and this is very much related to what Gennaro said, that the firms that are in this roundtable are actually firms that are more likely to be investigated to begin with.
Okay. These are the big names, so somehow they're going to always get into trouble. Is that the idea?
They have more attention from the regulator to begin with, from the agencies to begin with.
Anish, are you around?
Yeah. So if you want,
do you want to take that, because you know the data much better than I do?
Yeah. So two things, and I think these are kind of related in a sense. The first is that for the BRT design, we match, right? So on the BRT test, we're only looking at large firms to begin with, right? So if you look at the sample size, it's not huge.
Yeah, it's propensity score match to the extent you believe that design and so on.
Yeah. So to come back to your question, Daniele, you're right that if you're comparing, let's say, Amazon against, I don't know, your favorite local takeout restaurant, Amazon is going to get more scrutiny. But it's not, I wouldn't say it's the case that, for example, I'll give you an example, right? You're based in Miami, American Airlines is a BRT signatory, Delta is not, right? And so Delta is kind of our match control for American. Now, do I think American is going to get much more scrutiny than Delta? No, I think they're pretty similar firms in a similar industry. We match them to each other, and so I think they're going to get similar levels of scrutiny. And I guess, moreover, one institutional detail and one nice thing about the violation data as well. Most of the violations we look at, and specifically all of the environmental violations, all of the labor violations, these come from agencies which take what I like to call an kind of outcome-based, not intent-based enforcement approach. And so what that means is, if you think about the SEC and financial fraud, you know, you have to prove intent. It takes a while. You can maybe do 1,000 investigations a year, and so you have to think really hard about targeting if you're the SEC. Who do you investigate? With OSHA, the EPA, you know, the Wage and Hour Division, with most of these agencies we're looking at, it's really just, did something bad happen? Okay, great, you get a penalty. How much is the penalty? You know, we'll quickly figure that out and we'll move on, right? So you don't have this kind of, and I think there was a question, I quickly looked at the group chat as well, and I forget who asked this question, but that also maybe comes to one of the other questions that came up in the chat of, are you worried about kind of selective targeting? And I think in our case, one of the nicest things about our setting is that it's much less of a worry than in the fraud and lawsuit literature. For this reason that there's so many investigations. For example, OSHA conducts 40,000 investigations a year, right? The SEC conducts 1,000.
Can I ask a follow-up question related to this?
Sure, of course. Yeah.
So the year that you're capturing is the year when the penalty is issued, but does it matter when the investigation started, or at least just to have an understanding, do you know how long does it take from when the investigation starts to when the violation is actually, or the penalty is actually released?
Yeah, so two things, right? One is the penalty date that we observe is basically the date that it was caught while it was ongoing, right? So we see the end date. And now I'll give you, so one limitation of the data is that we don't always see the beginning date. We see it for some agencies, but not for others. But I can tell you just from looking into the agencies where we do have data, typically inspections happen every couple of years. So there may be a few cases where, fine, it was caught in 2018, but actually started in 2017. But it's unlikely something started 6 years ago and it was just caught today and we didn't observe the last 5 years. So inspections are frequent enough that it's really unlikely that, in some sense, you don't have to, the difference between when the violation starts and when it's caught, if caught, is likely to be relatively small.
Okay, thank you.
Good. Christina, you're next.
Yes, can you hear me?
Yeah, hi, hello.
Hi, hello everyone. Thanks for joining our webinar. So the question I had is about damage control. So maybe these DRT signing firms, they are doing that because they are bad firms, and this is one of the ways for them to redeem their reputation. And this is along the lines that, like how you concluded your talk, right? That you don't know what will happen with these firms in the future. But I think it would be very, very interesting to see what will happen, right?
Totally.
Will they become better performing firms?
Yeah, absolutely. Yeah, you're right. Maybe they're signaling that they're going to become better. Absolutely possible.
Yeah. So,
yeah.
So maybe it's a different paper. Probably you don't have space in this one, right? But maybe it's a different paper too.
More than space, we don't have data.
Yeah, exactly. Yeah. Well, thanks for your response.
Yeah, of course. Thank you so much. Yeah.
Okay, Saurabh.
I think my question is kind of maybe one refinement of Christina's, which is, you know, it could be window dressing. Like if it really is the worst performing firms that sign up and they're trying to do damage control, that could be window dressing, or there's actually a genuine intent underlying that. But I think your comments already addressed that point.
Yeah, it's hard to tell. I mean, in archival work, sadly, you know, we are limited to looking at history. All I can tell you is that the history doesn't match the stated intent. Now, I don't know how to measure future performance until it actually happens, right?
Right.
Well, there's an additional level of complexity out here, though, because all things may be happening in your data. Some firms are doing it for performance, others are doing it for risk, regulatory risk, some of them are signaling. And so on an average basis, the whole thing may just wash out.
Well, not wash, I mean, you still see results, but I see your point that there could be different motivations. And we can try and think harder about ex-ante coming up with some way to sort these firms out. Anish, right? Offhand, I don't know how to think of it. It's a good comment. we can certainly think about how to clean that out as best as we can, if we can. My guess, again, DJ, not that I, go golf with these guys, but by talking to the people who signed this, it was basically Jamie Dimon who rounded them up. And Jamie Dimon, my guess is, like Larry Fink, has political ambitions.
Right.
So, and he's about to retire. He needs a crowning legacy. In fact, the joke on Wall Street is that JP Morgan is so complicated that not even God can manage it. That's why we have Jamie Dimon.
Okay, we have Ejan Lee next.
Oh, hi, my name is Jin Lee. I'm a second year PhD student at Florida International University.
Hi, how are you?
Hey.
I have a question about this. I look at this, your table 5 and table 3. So table 5, column 4 and 8, both showing that
Okay. Hold on. I'm table 5, column 4 and 8, so that everybody sees that, right? Just keep talking. So I'll pull this up for others.
Oh, okay.
Yeah.
So as I look at this, the actual environmental violation is less significant, like marginally significant, and then column 8 is not significant at all, but then all the news variables are much more significant.
Right.
So, and then also table 3, column 8 also suggests this, that the signatory firms do not outperform their peers in providing some more disclosure to investors, as you mentioned as well. So I was just wondering, maybe these results imply that this paper might have more contribution on the disclosure literature side. So maybe it might helpful to explain the disclosure contribution parts. It looks like the news seems more impactful than actual violation to include in that index.
So to be clear, this is not firm-driven disclosure. This is what the press talks about this company, right?
Right.
And second, a lot of ink has been spilled on disclosure, some good, some bad. I'm not sure we want to add more to that. Yeah. I would stay away from disclosure. I don't know what the explicit link is. Sorry.
Okay.
Yeah.
Okay. Thank you for your response.
Yeah, no worries.
Okay, Sundaresh, you're next.
Can you hear me?
Yeah, hi, how are you, Sundaresh?
Hey, how you doing, Shiva? Hello, everyone. Hey, thanks, DJ and company, for organizing this interesting paper. I was looking at the one of the raters here, the MSCI, the guys who do the KLD 400 or whatever. And looks like, they have other databases. Like, one of the things I noticed was this thing called ESG concerns, where they claim that they actually analyze, monitor, and measure actual performance. So, which kind of seems like what you guys are doing too. I was wondering if there's some kind of a disconnect between their ratings of these companies and how they include them in the index, or is it they miss the actual verification of whatever is going on if they're doing a bad job, monitoring the companies?
So Anish, you might want to pick this up, but my understanding is that whatever is in the rating is also in the index. Am I right? Or is there slippage, other information that they bring to bear?
Well, so they don't provide the basically the mapping, the sort of, they don't provide the exact mapping, but they do say that they come up with an aggregate score, right, based on their they have so KLD or MSCI has these ratings along all sorts of dimensions, right? Like within the environment, they might have pollution and water and air and all sorts of stuff and concerns. And so they don't give you the exact, I guess it's proprietary, quote unquote, how they then map that into an overall score, which is then used to determine the index. So we don't know what, I guess, long story short, we don't know for sure if this ESG concern, the extent to which these ESG concerns feed into the ultimate choice of index. We just don't, it's a black box, and so we don't know. One would hope so, but our results kind of suggest that in as much as these ESG concerns feed into index construction, it's minor. We haven't looked at we haven't looked at these ESG concerns kind of on a standalone measure to see if these things map into the violations. That is something, I don't know if we have it, but if we have it, we could do it.
I don't think we do, but if we have it, we're happy to run it. Again, we are not out to show that these guys are, they're not doing their job. Maybe they are, maybe they are not. What is interesting to us is that, why would you ignore federal enforcement records? That's the first place I would start if I were constructing an index, right? Which is arguably, it's not fudged, it's not coordinated, it's all there. Yes, there are biases of the kind that people raised, in terms of detection and so on. But relative to what the street seems to do, I think what we have is potentially a better product. This is the other thing, so again, sometimes we often assume that people in the real world somehow know something that we don't. And by and large, maybe that is true. But after having spent time in New York, I'm increasingly beginning to doubt that assumption. They respond to incentives. If there's money to be made, there's a product. Is it the right product? Well, that's the question.
Yeah, thanks. I mean, I was just curious if they're missing something or if they're ignoring it, So, it's actually called ESG controversies, not concerns. But anyway. Thanks.
My guess, Sundaresh, and I have to look at this, but my guess would be that's again headline risk. Yeah. Because I'll tell you why. I mean, so coming back to my, just to give you a bit of a preview into some of the conversations, I teach fundamental analysis for a living. I do this with, a bunch of people. 15% of firms in the US report labor costs, 15%. Okay. Mm-hmm. So I don't even know what labor costs are for these companies, let alone, very complicated parameters related to S, such as gender, training, culture, which I've worked hard to try and measure. It's very, very difficult. So when MSCI says that they only use public data, what public data? I'd like to know. Because I'm not even able to find labor costs for more than 15% of US companies, something as basic as that, let alone deeper things related to S. There's better data in terms of environment, things like emission issues. But even that, we've looked kind of closely at some of that data. Scope 1, Scope 2, Scope 3 emissions. Scope 1 is supposed to be the emissions issued burned by the company. Maybe you can audit that and so on. Scope 2 and Scope 3 become very messy. Scope 2 is, what you buy from the outside. How on earth am I measuring emissions based on what I buy from the outside? Like say embedded in the package that Amazon brings me and so on. So that's why I'm kind of somewhat skeptical of some of these things.
Okay, thanks.
No worries, thanks.
Okay, Gennaro, you're up again.
Sorry. Can you hear me?
Yes, yes. Hi.
Yes.
So I was wondering, again, as a non-accountant, let me preface that. I was wondering whether a potential solution to the problem of people speaking without, talking without walking is mandating a set of disclosure requirements that need to be satisfied.
What disclosure? Tell me, Gennaro. I mean, I like my model. So here's what will happen. Europe's already done this, and I haven't looked carefully at this. But my guess is that it's already exploding to a point where it's unmanageable and non-comparable. So I've looked at a few in the US. I've not looked carefully at Europe. Hundreds of pages of self-congratulatory stuff.
Right.
Yeah.
Right, but the issue is that none of this disclosure is really regulated, right? So you can say basically whatever you want without fear of consequences. And
yeah,
so my point is, should we have a set of the GAP standards for ESG disclosure?
The SASB tried that. So there is a thing called the Sustainable Accounting Standards Board, which is a voluntary institution, and they wrote standards for by and large, every industry.
Right.
In terms of trying to segregate what might be quote unquote material versus not.
Right.
So it's interesting. I mean, if you're the Wall Street Journal type, they've gone after this like crazy. Partly because if you say open the cotton industry, what portion of it is organic, this, that, fine. You know, so you're wondering whether adding regulatory teeth to those voluntary standards would help.
Yeah, I mean, you know, having the potential for penalties from just talking without walking.
I doubt it. I'll tell you why. So let's say we make the SASB mandatory, right? So the cotton industry is going to reveal what portion of this is organic or not. What I want to know personally as an investor is what are the trade-offs? This is expensive stuff. You know, going green is not free. So tell me, to me, it's just another CapEx decision. Tell me how much is it going to cost? What is the payoff, right? Is there something wrong with that? So unless
that's fine. That's fine. But now we're just talking about the form of disclosure, right? But even in your framework, I would contend having those standards being mandatory and regulated would put some teeth on the tool. You know what I mean?
Maybe.
I mean, you can ask. I mean, you can design the standards whichever way you like, right? So the standards could be that you have to disclose what you're doing, how much it costs.
How much it costs to go green and how much it costs to fix your gender imbalance in your company and so on. Maybe, I don't know. The jury is out on does mandatory disclosure really make a big difference? But I'll leave that.
We have some evidence from food labeling and from caloric disclosures. So
which does make a difference.
They don't make a difference. And not only that, they're very costly because businesses reorganize. So for instance, we have a chain of restaurants called Houston's, and because they wanted to remain below the caloric disclosure threshold, they created another company called Hillstones, which has the same damn menu. But because they are few establishments, they avoid disclosing the caloric value of food items. So, I mean, like Shiva says, we want to know the trade-offs, right?
Yeah, exactly. It's not free. Nothing's free. You know, it's like telling people to lose weight and exercise. I try. Going green is not free. It's like trying to get exercise and eat less. Yeah.
But I mean, again, take everything I say with a grain of salt. So as I understand it, there are two models, right? We can mandate behavior, or at least we can mandate disclosure, and you choose your behavior. Now, if what we're trying to understand here is whether any of these purported socially responsible behavior that people are voluntarily disclosing is taking place, and they can do so spitting out words that have no meaning because there is no consequences from saying anything. If we don't want to regulate behavior, which I agree we don't, at least we should regulate the disclosure. That's my...
Where is the organic demand for this? Is the other thing you have to worry about a little bit, right? Because
so again, I'm starting from the starting point being that there is a demand for this socially responsible behavior, right? I'm taking that as a starting point. If we take for granted that the market, at least a chunk of the market, is interested in this part of corporate behavior, and therefore, if they are interested, it is material information because they use it to make their investment decision, then it strikes me as one of those things that we should regulate in terms of disclosure.
My hunch, Gennaro, is that it'll end up like the proxy statement, where we know so much about senior management pay that we barely know what they actually do. That's my hunch.
We have one last question. Doug, you've been waiting for a while.
Sorry. Thank you.
Okay, I'm back. Thank you. Bad news and performance are going to be intimately linked in any case. And I imagine that for any actively traded fund, not the index funds, of course, but any actively traded fund, bad news is going to be associated with whether or not a firm is in my portfolio. Could you capture all bad news and show that it's the environmental or social or governance bad news that causes the dropping from these funds instead of just the general bad news effect? That would be more persuasive.
We tried. It's absolutely a good point. So our variables are these are from Violation Tracker. If you can see the screen, the so-called news from RepRisk, which is a database which tries to parse headlines into negative labor news, environmental news, etc. We also control for so-called fundamentals, which is trailing returns, accounting performance, size, market to book, volatility, and so on. So there is some evidence here in table 5. Hopefully that addresses at least some of what you're asking.
I agree there's some evidence there, but I think more generally you could capture a bad news component and show its effect on all actively traded funds, and then show that the bad ES&G news component was different.
I see. Okay, we can certainly look into that.
Okay, Shiva, Anish, thank you so much for inaugurating this session and the series, and hope to see you all back next Friday. Be safe and well.
Thank you so much. This was, refreshing. I miss being grilled. That's what we do well in academia, right? Companies are benign dictatorships. So.
Okay.
Okay. Thank you. Thanks, guys.
You.
Bye-bye.
Thanks, everybody.
Bye.
Bye.
Bye.